Right now, the American economy looks unstoppable. GDP is growing, unemployment is low, and companies are raking in record profits fueled by AI investments. But the view from the street is different. Gas prices fluctuate, grocery bills remain at historic highs, and total credit card debt continues to climb month after month. If corporations are making billions and the economy is supposedly booming, why does it feel like your paycheck disappears before the month even really begins? To understand this disconnect, we need to track a standard paycheck through the specific financial pressures of 2026. Comparing the top-line economic headlines to a standard household ledger reveals a growing friction. The widespread feeling of falling behind is a reflection of these two worlds moving in opposite directions. The moment your salary hits your bank account, non-negotiable living expenses take their cut. This includes the largest monthly drains: rent, the weekly grocery run, health insurance premiums, and out-of-pocket medical care. You've likely heard reports that inflation has cooled. This phrasing often leads people to expect that prices at the store are about to return to where they were a few years ago. This chart clarifies the situation. It plots the cost of living over the last few years. Following a steep climb from recent inflation spikes, the line flattens out into a high plateau. Cooling inflation simply means prices are rising more slowly. It does not mean they are falling. Those previous price hikes are now a permanent part of the landscape. When we overlay average income onto this new reality, the problem becomes clear. Because wages have not climbed at the same rate as that plateau, everyday essentials now consume a significantly larger portion of your total earnings. This is the inflation illusion. Families are trying to balance their lives using 2026 prices on budgets that were built for an entirely different economy. After those inflated essentials are paid, the next drain on the paycheck is debt servicing. This covers car loans, mortgages, and most importantly, credit cards. To combat the inflation spikes we just looked at, the Federal Reserve has kept interest rates elevated. This policy is designed to slow down the national economy by making it more expensive for everyone to borrow money. For the average consumer, this creates a specific trap. If your paycheck doesn't cover your rising bills and you use a credit card to bridge the gap, you are borrowing at some of the highest rates in decades. Look at a typical credit card balance. This block represents your principal, the actual cost of the things you bought, like gas or emergency repairs. Because interest rates are so high, a second layer of cost rapidly stacks on top of that principal. Over time, these interest charges can swell until they rival the original debt, making it nearly impossible to pay off the balance. The tools used to stabilize the national economy have directly squeezed the household budget, turning small monthly shortfalls into long-term debt. This struggle on the ground raises a question about the other side of the economy. If the consumer is struggling, there is a reason Wall Street indices are still reaching record highs. Stock prices are driven by corporate earnings and investor optimism about the future. Many companies maintain their profits by finding efficiencies, investing in automation, and cutting their own internal costs. While things like lower energy costs can help a company's bottom line, those savings don't necessarily lower the cost of your rent or your insurance premiums. The stock market is an indicator of corporate health and shareholder value, not household stability. Record-breaking markets and household financial struggles can and do happen at the same time. While you cannot control interest rates or global inflation trends, you can adjust the way you manage your own ledger. The immediate priority is avoiding high-interest debt. This requires building a cash emergency fund, even a small one, to ensure a surprise expense doesn't force you to rely on a high-rate credit card. For the long term, the strategy remains consistent: spending less than you earn and investing steadily. When budgets feel this tight, it is easy to be lured by get-rich-quick schemes, but those often result in losing what little capital you have left. In an economy where the macro data and the household reality are at odds, maintaining your own financial discipline is the most effective way to protect your paycheck.